We have one other way to kind of measure performance, and it's called performance attribution. We want to look at the differences in return, and we want to make comparisons to what they refer to as a benchmark or a bogey. Right? And we'll talk about what that means here exactly in a second. But this difference can be due to two different types of decisions we make. The first is the actual stocks we pick. That's the selection effect. And then how do we allocate our investments between different asset classes? This is the allocation effect. So each of these is going to be considered to determine where the differences in the returns come from. The idea then is if we know that our selection of stocks, the selection effect is negative, we need to improve how we select our stocks. We need to find better investments. If the allocation effect is negative, that implies that our strategy for how we want to invest, say 60% stocks, 40% bonds, that is out of whack with the way the actual market is working. So the idea here is to try to understand the components of the differences we have. So the selection effect is just the weighted average of the difference between the asset class returns and the benchmark returns. So we need to identify the benchmark for use here. So Morningstar will tell us what those benchmarks are for mutual funds. In a previous video, we looked at how they categorized those funds. So if we had a mutual fund, or we were trying to create a portfolio that was 80% stocks, 20% bonds, we would want to have a benchmark or a bogey that represented that strategy that took 80%, 20%. What would that have actually done if it was a perfect choice? So here we see we have the allocation target. We want 60-40. But after the market has happened and prices obviously changed, the actual allocation changed. It's now 55-45. The benchmark that created the 60-40 gave us 12%, and 4.5% is what the bonds made. So the fund itself, 13.5 and 4.5. So to find the selection basis, we take the actual allocation and we multiply that by the difference of the returns. In this case, we have 0.825 for stocks, negative 0.045 for bond selection. Add those together, we have 0.78. So again, how would we find these benchmarks? So for the equity fund, maybe we use the S&P 500. For the bond fund, we're going to use the Morningstar U.S. Corporate Bond Trust, right? So again, we're going to calculate these differences, and then we weight them by the investment weights, the proportion weight. If this number is positive, we have exhibited good security selection. And I think we can even drill down a little bit lower and say, well, we're doing really good at selecting stocks, not so good when we're trying to select which bonds to invest. If we want to increase our returns, we need to figure out how to do this piece a little bit better. What about the allocation effect? This is a little bit more complicated. Here we're looking at how the portfolio is invested across asset classes. So each asset class has a return associated with it, and then we break down our portfolio by those proportions. Here's the proportion, the weight of our portfolio. This is the weight of the bogey. Multiply that by the return of the portfolio and the return of the bogey. So again, we need these benchmarks, right, to understand relative how we're choosing these weights, right? So I think it's easier to see this in an example. So the overall benchmark, the bogey benchmark, which would be our 60, 40, 12.5, and 4.5, is 9%. So now we look at the allocation effect. So we're at 55. We wanted to be at 60, so that's obviously negative. The benchmark earned 12, but our overall benchmark was 9. That gives us negative 0.15. The bond allocation similar, negative 0.225. So when we add these two together, we end up with negative 0.375. So negative allocation effect indicates that asset allocation is not being done very well. When we combine these, again, our portfolio return was 9.405. The overall benchmark was 9. Selection effect 0.78. Allocation negative 0.375. Add those together. Our overall difference is 0.405. So again, we can say that in general, our performance attribution is doing well. It's better than average. However, the asset allocation piece of our strategy is not working as well. Let's look how this might come out in an Excel format. So here we have some sectors. We've invested in this index or this portfolio that has, in this case, there's 28.5% is invested in information technology. 8.6% is in industrials. Now the benchmark that we're comparing to has 27.6 is in investment technology and 8.4 is in industrials. So our portfolio weight is different than our benchmark weight. So of course our returns are going to be different. So what do we need to calculate for our analysis here? We need our returns, obviously. We know how to calculate returns. Next is the difference in the weight. 28.5% minus 27.6% is 0.9. The next thing we do is we do the sector return minus the sector bogey. 28.5 minus 27.6. Again, we end up with negative 2.1%. What is the sector contribution? It is this number, right? E13. So if you look here, here's E13. This number minus E15. Oh, excuse me, E13 minus E15. So what is the difference? And we have that sector contribution. This is the return that we got, average return that each sector provided above the average per firm. So this is the return. This is the return of of our portfolio. This is the return of the bogey. So what is the actual return? 0.28%. So that 0.28, what can we attribute that positive return to? Negative 0.83 is selection effect, but the allocation effect is up 1.12. So again, what would we say? In this case, we have positive performance. We're performing above average. However, the selection part of our investment strategy is not doing well. We need to select better investments within these sectors. But choosing the sectors, this weights, that was good. So the next thing to explore is something called market timing. So in a previous selection, right, section, what we were considering were static asset allocations. But some managers move assets among sectors depending on the environment, right? This is what's referred to as market timing or sector rotation strategy. So if we were investing to mimic the S&P 500, then we should have a beta of 1. And the relationship between risk and return is this straight line relationship. So if we're doing this correctly, right, and we are doing market timing, or we're not getting market timing, we would end up with this straight line relationship. If we could time the market well, so we'd be investing more in the market in good years and less in poor years, we would have higher returns at the high points, but we also would have lower lows in the market than the market. The relationship here between risk and return will be concave. If we're not doing this well, right, then the returns are going to be lower than the market returns at every risk level. So the relationship between risk and return will be convex. Right? So what's the plan? How do we know if we're doing this correctly or not? We can incorporate a variable in our regression formula. So our regression formula is going to include a test for curvilinearity. That's what this square is. So the constant here, the outcome of our regression, is just the risk-free, the return on the market minus the risk-free rate squared. If C is greater than 0, then we are concave. Then that is this picture here, and we are choosing the market better than average. If it is negative, then obviously we're poor. We're not doing a good job at market timing. Of course, since we're doing statistics, we also need to understand about the statistical significance. So let's look at this example. Here we have a mutual fund, SBM LX, I think that is, and the S&P 500. Here's the squared of the return here. And then ultimately we want to run our regression. So our regression, the intercept is 0.0005. The beta, 1.16. That is the beta of our portfolio here. And C, that is our squared number, right? It's negative 1.376. So here C is negative, but it's not statistically different from 0. How do I know that? This number here, 0.293, is not less than 0.05. So this tells us, in any case, right, that as far as market timing, we may not be doing as good a job as what we think, or we're lacking in that skill set. So if good market timing is working, right, what's the risk of this? Well, when it's working, we can, in this case, they said they created the index from one year to the next, right? And then they says, well, if you picked it perfect, right, every time the market went to its high, you picked its high and you bought, and every time it was going to its low, you sold, what would you earn? 18 to 40%. But what if you did it the exact opposite, at the worst possible times? So when the market was going to go up, you sold, and when the market was going to go down, you bought, right? So again, if poor market time return, in this case, it's what, negative 20, right? So again, when you're doing it badly, it can hurt a lot, right? So it adds considerable variation to our results when we try to beat the market, if you will. So active measurement or active management means we're investing to beat the market in an active investment strategy. We're going to pick good sectors. We're going to good stock, excuse me. We're going to overweight sectors that turn out to be good choices, and we're going to time the market well. Fundamental analysis is based on cash flows and financial statements. Technical analysis is based on stock price movements. We'll talk about this as we continue the rest of our videos. But active managers aim to outperform their benchmarks. Passive management is trying to mimic an index, right? It's a passive strategy. It's a buy and hold strategy, if you will. So professionals are challenged to consistently beat the market on a risk-adjusted basis. Most investors should focus more on their financial objectives and having a well-diversified portfolio than to try to beat the stock market. So in conclusion, we've had several tools to analyze performance. There are tools that look at performance relative to risk. There's also tools to look at how we choose our investments. How often should we do this? How often should you be reviewing your portfolio? There are those folks that have lots of time, and they may do this every day, which I think would drive them crazy. Probably every quarter, certainly no more than once a year, you should review your investment strategy to make sure it's still what you want it to be. So when we're done with this investing, with this information, what should we do, right? So these are the magic pills, right? If you knew the answer to this, you wouldn't be making mistakes, right? So we make choices to invest, but then we also need to make choices to reinvest and rebalance. Investing is easy. When we talk about reinvesting and rebalancing, now we're adding a psychological aspect to investing, right? If a stock goes down, should we sell it and move on? Behavioral finance tells us that people have a tendency to hold on to those things that do poorly because they think they're going to come back. So again, lots of things to talk about throughout the rest of our videos on investments, but I look forward to seeing you in the next video.